Hello and welcome to the North Metro SBDC programming.
Hello, everyone. Welcome to Access to Capital. I'm Raul Lopez. I'm the Assistant Director for the North Metro Small Business Development Center, and we're located out of the Front Range Community College in Westminster. But we do serve various cities in the area, and Arvada, who we're partnering with today to bring you this part of the finance series, has brought this amazing project to us, and we're happy to be here to be able to serve and get this out there to y'all. One real quick thing about the SBDC. Real quick, we just do free education and one-on-one consulting for free for small business owners. So for all you and or aspiring business owners. So I do want to hand it off real quick to Isa. She is the executive director to AEDA, and she is going to talk a little bit about what they do, and then go ahead and hand it off to Karen, our speaker today.
Thank you so much, Raul. Hello, everybody. Welcome. Thank you for joining us on this webinar. My name is Isa Petrakowska. I'm Executive Director to Arvada Economic Development Association. So we're a free resource for all businesses located or wanting to locate into Arvada. Help from anywhere from home-based businesses to our primary employers. Really excited to see so many folks on the call. I know we have some of our partners here from Westminster and some other municipal representation from our region. So thank you all for joining. Again, we're kind of offering this out not just to our Arvada businesses, but to our regional partners as well. And I want to give a special shout out to Sarah Miley on this call. She's on our team with Arvada Economic Development and really worked hard to put this financial wellness series together in response to what we're hearing from a lot of our small business owners. And without further ado, I will hand it off to Karen to introduce herself.
Good morning, everyone. First off, pat yourself on the back that you are taking the time to put your business or your future business in a better place. Too often, business owners just jump in, think everybody's going to buy their product or service, and then you figure out, oh, wait, I shoulda, coulda, woulda. So my name's Karen Patel, and I am a financial consultant, one of them, with North Metro SBDC. I was raised in a family-owned business, have had businesses, currently still have my own financial planning practice, but I was a banker for several decades. I have an economic development background, and just know that often money is just very stressful for people. So if we can start, Raul, with our presentation, we will have questions. Definitely, I want this to be open-ended. And next slide. There we go. Yeah, 40 years, you give or take. I've been around. All right. Congratulations. You are, nope, go back. Went too fast. There we go. Hopefully we can manually advance them. You're living the dream. Generally, people become entrepreneurs one of three reasons. Either you hate your current job or your boss, so you're going to start your own. Two, you think your boss is making all these profits, except you have no idea about this thing called overhead expense. Or three, you really have that passion. And so welcome to the world and hang on tight. And so now you've figured out you need some money. You have some, it's not enough. You need some moolah, you need some dollars, you need cash. How does it all work? And that's what we're gonna talk about today. So what type of funding is out there? What is best for your small business? And of course, the most important part, how do you actually get it? And you start by listening in today and being ahead of all those other business owners who haven't even gotten this far out. But it's about planning. So let's jump into our first type of funding sources. It is you, yourself, and I. Whether you have it from your own bank accounts, better put my glasses on here. Your own bank accounts, you might have some cash value in your life insurance contract. Retirement is there, but you know what? I really don't suggest that you use that money. However, it's your money. You have to figure it out. It's your business, right? But if you don't put in your own money, why the heck would any lender come back and give you theirs? So you've got to have skin in the game. After yourself, the next one, guess what? Family and friends. Might be your parents, might be your sibling, might be grandma. Grandma's always a good source if in fact you need some. And part of getting money from family and friends, it can be a formal, a pseudo formal, or an informal. I need 5,000, pay me back when you get there. Or you might say, I can pay you $100 a month, $50 a month, and it might take you forever to pay back the parents. But your next source is family and friends. After that, we've got government resources. So for instance, City of Arvada does have a revolving loan fund. They have principle where they basically recycle or revolve that amount of capital and to share with other businesses. So if you get a revolving loan fund for 20 grand and you pay it back, then that principal is used to then pay it forward and allow future businesses to then borrow it from the city. So revolving loan funds, not all cities have it, some counties have it, depending where you're at, but that is, I would say, kind of the next source that could be a possibility. I often have people asking me for grants, free money. Well, yeah, free money is in the comic books, is in the childhood books. Again, free. It's not free. If you don't put in your own money or you get it from family and friends, don't expect the magic fairy to come out and just say, here, I want you to have 20 grand. Doesn't work that way. If in some cases you have a unique product or service, you are a minority, disabled, a veteran, there could possibly, maybe be some opportunities for grants as you complete your business plan and you know exactly what that money is going to be used for. So it is not just free money. And of course, one of the best ones are SBA guarantees. So as you get loans from some of the lenders, and we'll talk about this, first, second, or third tier lenders, sometimes they will be more comfortable in lending you money with an SBA guarantee. If something happens, if for some reason you're not able to pay them back, and you're going to hear me say this over and over again, it's about your ability to pay the loan back. And the SBA sometimes, when it's borderline, will come in with those guarantees. Another source of funding that so many people don't think of, especially when you are selling products or you have a commodity and you are purchasing components from some other business in order to build your end product, is getting credit terms from your vendor. Perhaps you don't need to have a COD, cash on delivery. Perhaps you need to buy, let's just say, scissors in order to make the super duper scissors component. And maybe they'll give you 30 days. So if you're going to a trade show, or you're going to some convention and you're going to sell your widgets, and you won't get that money back until after that event, that's when you can pay them back in 30 days or maybe 60 days or 90s. The larger the purchase, think about it on their end, you are bringing them more revenue, right? So the more you do, you're helping them make profits. They might be willing to grant you additional credit so you'll buy more. Or maybe you have a seasonal business and you need to buy $50,000 of wood or plastic, let's say plastic pieces, in order to compile and create your product. Knowing that you need to have all of your inventory in summer so you can produce your product, and then of course sell it over the holidays, what have you, and then when you get the influx. So your own vendors could be a really good source. If you have equipment, it's kind of the same concept. Whoever the manufacturer is, they want to have you buy a bigger, more expensive product that they might offer you terms. If not purchasing the product, it could be lease, right? There's a lot of equipment lease programs out there, rather than having to come up with that upfront cost of 10 grand in order to buy a piece of equipment that's 40. Similar to a car loan or lease. And so your industry partners, being a member of your association, can also give you some ideas as to what might be some opportunities out there to borrow within your own industry. And then, of course, our next funding resource are outside investors. I think we all know about Shark Tank. And there's angel investors. And I really think there's kind of two kinds of angel investors. The ones who have their own capital and they're looking to make a profit, get a return on their investment. And then there's those angels, if you're fortunate enough to find an angel who has the passion because of the industry or because of the product, or maybe because of your niche market that you serve. So knowing that there's a difference, if you are looking for outside investors, you all should know this. They want a piece of the action. 10 years ago, an angel investor, let's say, would give you 50,000, 100,000. We'll use round numbers for everybody. They'll give you 100,000 and they would have expected, a 12% return in 3 years. Let's say 2 years. Well, that was then and this is now. Now they might give you that 100,000, but they now want a 12 to 15% return, and they want it in 9 months, and they want 10% equity in your company. And that's where the Shark Tank, if you've seen some of those, where they've negotiated, I'll give you this amount. And they're generally startups, right? So there's nothing proven that they're going to get their money back. So the risk that they're taking is, okay, at least if I have some ownership and there's some equipment or whatever, maybe they'll be able to get 10 cents on the dollar or 20 cents on the dollar if they're not successful. And the last funding source where everybody thinks kind of first is that financial institution. I'm telling you, if you don't have a business plan, and we'll go through some other things to help you prepare to someday get in front of that lending institution. But there's basically 3 types of lending institutions. And this really is kind of your last resort of trying to leverage your assets with the bank in order to get that capital. First tier, everybody knows, your national banks, your Chase, your Bank of Americas, of the world, right? Your second tier are more of your regional banks. First National Bank of Omaha, FNOB. FNBO, sorry about that. First Bank, Mountain View Bank of Commerce. The regional banks possibly tend to, because they're next door to you, in essence, they're looking to help the community grow local businesses. But they also, because they're next door to you, can also walk over and see what's going on. So the big brother is a little bit closer than maybe the large tier 1 banks, who, depending on the amount that you borrow, it might totally be an online experience. If you're looking to purchase real estate or $500,000, then you might have a local small business lender or an SBA lender who, from a tier 1, will talk with you and get to know you. The tier 2s may or may not, again, depending on the amount, depending on if you're selling a product or a service, or if you're in construction, very different tiers, right? Your alternative lenders basically are nonprofits. Some of you may not be aware, but credit unions are nonprofits by definition, and they were formed to help consumers with their financial needs. Some of the credit unions, and I know next month or next session that AEDA is putting on, is presented by On Tap Credit Union. And so they will be presenting some other ways personally that you can prepare yourself and some of that financial knowledge that you need. The other nonprofit alternative lenders, and there's really three, four, five, give or take. Through the SBDC, we often use Colorado Enterprise Fund, B-Side Capital, and then also Dream Spring. And in some cases, these alternative lenders, as nonprofits, will lend you money or build a relationship with you only after you've been declined by a bank. So they're kind of that next step. Even though you get declined by a bank, because tier 1 lenders have very, very specific lending criteria, underwriting criteria. And so maybe you don't get approved by a tier 1, but that's okay. You have other sources from a nonprofit standpoint that will do perhaps a little bit more hand holding. They can help you with your business plan. They will help prepare or to help you prepare your financials, your balance sheet, your income statement, your personal financial statement. They can help you and guide you so you are more bankable in the future. Knowing that alternative lenders are as nonprofits, they might take on more risk, higher interest rate, but perhaps they're more flexible in their terms. Maybe they can give you an equipment loan for 7 or 10 years versus a first tier bank might only give you 3 or 5 years. And it depends on that cash flow. But kind of reviewing funding source, look at yourself in the mirror. It starts with you. It starts then family and friends. And then you can reach out to other resources to leverage the capital or the cash that you are putting into your own business. Sarah, do we have anything in the chat that somebody has a quick question on this before we move on?
No questions in the chat, but if you have any questions at this point, feel free to unmute yourself and ask, or put it in the chat and we can address it.
Wonderful. All right, let's jump on to our Next slide. And of course, now that we know where possibly we can find some more lending sources, we're going to go into what's called the 5 C's of credit. There we go. 5 C's of credit is kind of banking 101. This is kind of their guidebook as to when you become an entry-level lender. These are the things to think about. And a lender, I want to jump in here. Lenders are extremely regulated. They can tell you things, they can't tell you things. I'm no longer a lender. So when I'm consulting with SBDC clients, I get to tell you all those things that they can't tell you. It's not that they don't want to, but they need to make sure that they are treating all the potential customers in a similar way. And they have a very rigid process that they have to go through to make sure everybody gets a fair shot. I, as one of the consultants, can share some of these things. Now, I'm going to jump from capital, collateral, conditions. I'm jumping into character first because I can tell you from my lending experience, it comes down to whether you have the cash or not. But if your character is such that you've had charge-offs in the past for whatever reason you chose, or you chose not to pay someone else, which will reflect in your FICO score or in your D&B report as a business, a lender's not going to lend you money if you've already proven that you're not going to, there's a risk that you might not pay them back. Number one rule as any lender, they're a business. They need to make profits just like you. And it comes, they don't want to foreclose. They don't want to repossess. They just want you to pay them back. And so one of the key elements for those of you, I know almost half of our audience are startups. You need to look at your personal FICO score. If it's below 650, you've got other work to do before you even attempt to reach out to a lender, because that's kind of the minimum that they will even consider working with someone to potentially lend. So happy to, the SBDC, we have one-on-one consulting that we can provide you. And there's things you can do to impact your FICO score. Dun & Bradstreet on the business side was the only place banks looked at 25 years ago. Now with technology, there's so many more resources and vendor credit, things like that, that they also can tell the strength of the business. So those of you who've been in business for 10 years, you should know your D&B as well. Make sure that it's accurate because that's what lenders will be looking at. Let's go back to the first of the 5 C's of credit, capital. We already talked about this. What is your skin in the game? If you've put in $2,000 and are asking to borrow 200,000, what do you think? Now, if you've put in 20,000 and it might be the value in equipment, cash, whatever you have of your blood, sweat, and tears that you've put into the company, and now you want to get some equipment, which goes on to the next item, which is collateral. Perhaps that's a way that a lender will feel comfortable that you've put your skin in the game, and you have some equipment, even though lenders cannot, when you are applying for a loan, they're not supposed to say, well, we'll only make this loan if you give us collateral. You are presenting your business plan. You are presenting your growth, your expansion plan. You can offer collateral, which will make the lender happy because they don't have to ask you. Whether it's equipment, if you are a closely held corporation and you are a service business and your product or service is all in your brain, a lender's going to say, well, what if you get hit by a bus tomorrow? There goes your business. If you have a life insurance contract, you could offer that as collateral, but know that depending on the dollar amount, depending on the cash flow, depending on the risk that they see of your ability to pay back, that might be a condition on the approval. But collateral is not going to be part of the conversation when you're talking about your business plan and what you're looking to do. Conditions, good, bad, or otherwise. I recently had an SBDC client who's in the medical device industry and, been in business 9-10 years, and their trajectory of their revenue profits has been phenomenal. And then because a lot of R&D, creating new products, and then what happened in 2020? COVID hit. But that's okay because the federal government said, you know what? We need this R&D to continue. We need to help our economy. And so we're going to throw in some federal funds, and a lot of the VCs, the venture capitalists, companies, woohoo, we still have money. Well, guess what happened this last year? Oh, all that government money, the COVID money ran out. It's his industry. He could be the best company, the best product, the best minds, talent. But in his case, if the industry does not have favorable trends, that's a challenge for the lender to whether or not they want to take that risk. Does the lender know as much as they could or should about the industry? But if they don't, that is your opportunity to inform them, to sell them, to let them know these are the projections 3 to 4 years, even though reports, data, which generally are pretty accurate, but going out, they might say, industry's tough right now. But good FICO score, good future business plan. They're going to want to hire a salesperson. This is their marketing plan. These are the new targeted markets that they're going to approach to increase their revenues, which then, of course, increases cash flow and gives them that bottom profit margin to guess what? Give them the cash they need to pay the lender back. So without your pre-planning and understanding a lot of this, you won't be prepared for the lender, and the lender's going to say, no, so sorry. We talked about character and capacity. I've mentioned this before. It's your ability to pay back. And that comes into your financial statements. That's a story. A lot of people who they're not a numbers person. They're a creative. They're in healthcare. They're in whatever industry other than finance. They just really get nervous and they don't like numbers. That's okay. You are able to hire that, whether it's a bookkeeper to help you, whether it's an EA, which is an enrolled agent, or a CPA, a certified public accountant. EAs and CPAs are very similar, except a CPA is licensed to do audits. If you're a closely held company, you're controlling your business, do you need an audit? No, unless the dollar amounts of the money that you're looking to borrow, your lender might require it. But if you don't know your numbers, you need someone to do the legwork to then have you review the financials. And one of the biggest tips that I give to small business owners. Those of you who've been in business over 10 years, you know your financials, you know your cash flow. But for startups, when you have your revenue and then all of your expenses and your profit margin, one of the with your expenses is if you're using an Excel spreadsheet and you're not necessarily using Gusto or QuickBooks or some other software for your industry, set up a column and look at the percentages of the expenses against the revenue. It might be, again, $1,000, $1,200, $2,000. If you just look at the numbers, you're going to say, wow, that really went up. But look at a percentage of revenue. If your revenue was 50,000, 52,000, and you all of a sudden had a big contract or what have you, and your revenue went up to 75,000 that month, that little bit of an increase in that expense as a percentage of revenue, that's what tells the story. But knowing your financial statements, both income statement, balance sheet, that is the main tool that a lender's going to look at. Let's talk about what's best for your small business on the next slide. It really
Real quick, Karen, we do have a question.
okay.
Let me see real quick. Lori is asking, will the lenders look at money you already put into your business?
Well, I'm sorry, microphone or I don't know. Will lenders look at money what?
Oh, will the lenders look at the money that you've already put into your business before you start working with them, or do they base their view at the point when you with them? What does that skin in the game look like? I think that's what Lori is asking. Lori, if that's not correct, please start off.
I think I heard most of it. Hopefully everyone can hear me okay. Raul, your microphone's little sketchy there. Yes, definitely. The money that you've already put in, it is your job to account and basically tell the lender, I've already put in 60 grand of my money because I set up, I have my website, I have my marketing, I have, whatever I have there. I've bought equipment, my laptop, my 3D printers, my whatever. So yes, that's up to you to be able to say, this is how much I've spent. Now, if you say the money is to pay my phone bill, you have a phone bill whether you have a business or not. What is the money that you've put to start up that business? Hopefully that answers that question. We can talk about some more in a little bit.
Karen,
Yes.
Sorry, I think there was one more aspect of that question, maybe, and Lori, correct us too if you're wanting to get at more, but I'm just wondering how important it is that you demonstrate that you've put money into your business already.
100%. The person asking the question must have missed the very beginning, which is, if you don't have skin in the game, don't expect somebody else to take a risk on you. Number one funding source is you, yourself, you. The second funding source, perhaps you can get money from family and friends. You can either explain that, or you just happen to have, $12,000 in your bank account. Okay, that's your money. So absolutely, if you don't have skin in the game, and it depends on how much you're looking to expand your business, how much more that you need. Maybe you just need a working line of credit because you have a seasonal business and you just don't know. But if you have an 800 FICO score and you've already put in 50,000 and you just want a $35,000 line of credit, that could be doable. It just depends. But yes, you need to put in skin in the game. And all the decisions that you make, it is your business. The SBDC, the city of Arvada, they're there to help guide you and give you those resources. But at the end of the day, it's your business. It's your business plan. We're not going to do that work for you. You wouldn't want us to, because we don't understand your personal financial situation. Are you the sole income of a family of 5? Or are you one of 2 or 3 income sources of a family of 2? Very different. And a lender will look at what are those backup revenue sources. If this is something, hopefully you don't all go and quit your job and then decide to think about starting a business. Hopefully you think about it a year prior before you jump in and actually quit your business to make sure there's revenue. But if you have a spouse or a family partner that, you know, they're bringing in 300,000 a year and you have no debt, together, and you don't have to worry about your personal financial expenses. So you, because of the complexity of your business, or again, the seasonality, you have a short window in order to get your business off the ground. So you had to quit your full-time job to get into this business if you're a startup. If you've been in the business, you've been in business over 10 years, you know, getting into the purpose of your request, we're finding a lot in talking with other lenders. A lot of it is refinancing, because you did borrow, or the money that you borrowed was from a predatory lender that charged you 25%, and you just took the money and now you're like, I can't afford it anymore, what have you. But anything that you want to do, first and foremost, know this is your decision. One of the things I'll throw in here when I consult with businesses, no matter what your product or service is, especially if you're a startup, you need to take one day a week. You pick the day. You pick whether it's Thursday morning from 6 to 8 or Thursday afternoon from 4 to 6. But one day a week, you have got to put on your business owner hat. You're not designing, you're not creating, you're not selling. You are looking at your business decisions of what needs to be made. The other thing with your business, are you looking, is your business going to be around for 3 to 4 years and then you might try something else? Or is this your lifelong dream and you're looking to have your business for 25 years in hopes that someday you'll sell it and get that big retirement paycheck when you sell it? If you, all of those business decisions you make, I highly recommend you think of the long-term picture and dream that you have for your business, because looking at long-term decision making definitely affects those short-term everyday business decisions you have to make. We all have to make decisions on the fly because we have to, but to give yourself that foundation in making those decisions, look at it from a long-term perspective. A lender wants to know that you've thought about that long-term. Is your lending request just to get by? You want to purchase some widgets because of economies of scale and you need to get it, and then you'll be able to increase your profit margin. The lender wants to know what is your future long-term dream or possibility, or the new market you might be going in. Maybe let's say you've been in a market, a niche market for 7 years, and there's a new market out there that you want to go after. and you want to walk into it with baby steps. Let your lender know that. Remember, they should be your partner and help guide you in your strategic decisions. Coming back specifically on the purpose of your loan request, is it for startup money? Is it for TIs, also known as tenant improvements? Is it to refinance? Or have you been around and you want to expand? Your lender's going to look at it very differently. For some of you who are in your startup mode and you haven't done this before, generally, if you're a startup, lenders are not willing to take a risk if you've been in business less than 2 years. That's just how it is. And basically, because I don't know, Marshall, you're a lender. If the rule on the street is 80% of all startup businesses fail in the first 9 months to a year. And because that history and experience is there, that first 2 years is tough. But you could potentially, if you've been in the industry for 25, 30 years, you're 55, you just got laid off, you've got all that experience, and now you're just working into a new business, a consulting business. And so the vision of that startup is a little bit different than if you've been walking dogs and now you want to, sell widgets of whatever. So, TIs, tenant improvements, when you have a physical location, and I have several clients who are in the creative space, the video recording, the audio recording studios. So maybe you need to get new systems, you need to new carpeting, you need lighting, what have you. Tenant improvements that you improve in your facility, when your lease runs out and you leave and you go someplace else, you say bye-bye to that $20,000 you just spent to make your business facility better. There's not a lot of lenders that will only lend for tenant improvements. That is your decision to change the paint color, to change the carpeting, what have you. That's where that money comes from you. That's your skin in the game for the appeal of your business. Types of capital, short term, we kind of talked about that. Maybe you just need it for a little bit. If you have government contracts and you get paid every 6 months, you'll get paid and you can get out of debt, but you have to get from A to B to that point. Working capital line of credit, same sort of concept of you need to make payroll weekly and you only get paid from, 40% of your customer base only pays you monthly or every 90 days. Well, how are you going to pay payroll? Because that's what the demands of labor require, a weekly paycheck instead of twice a month. Long-term types of capital, you're purchasing equipment. They'll look at what is the depreciable asset age of that asset. Think of it like cars. It worries me a little bit that some manufacturers now offer 7 years financing. Well, depending on the car, it might not last you but 4 or 5 years. Why would you want to owe money past the length of the life of that asset? And of course, capital, primarily with real estate, there's 504 programs where 50% of the money comes from the lender, 40% will come through an SBA guaranteed loan, and 10% is all you need if it's on real estate. So in some cases, capital can be, depending on which tier of a lender you have, some might be more generous, some might be less generous. on capital loans. And we talked about the types of lenders. So, one thing, back to your request. It very, very, very much depends. Are you a service business, a product-based business, or are you in construction? Lenders have different opinions on whether they prefer to lend to the service industry versus wanting and needing collateral if you have a product. And of course, construction. I grew up in construction, 1.5-inch road gravel put me through college. I understand construction. I have an accounting degree and I understand how the financials work with construction, but it is a risk market. Construction, restaurants, cash businesses, because there's no accounting of the cash flow, lenders, almost have to find a specialty lender or have a really good relationship with your lender and they can work with you. So, how do you actually get money?
We do have a quick question.
Okay.
G. Rooney's asking about, for startups, what are the type of lenders should we look at since tier 1 seems to not be an option?
Tier 1 is not your best option, but depending on, again, going back to your personal relationship, if your family of 1, family of 4, you've been a customer a long time, you have great FICO scores, they can see you have savings, investments, you could with a tier 1. It depends on your relationship. I would almost start, honestly, with the SBDC to find out if there's some government programs. You can also check with your city, the revolving loan fund. Maybe they can help you. I do know a couple of the cities do have small grant programs, $1,000, $5,000 for startup if you're in their community. Otherwise, the nonprofit lenders might be your best bet, but generally they want to see that you've written a business plan, you've gone through the process with a lender, a primary lender, and I hate to say it, get declined, because that's part of their mission and requirements as a nonprofit lender, that they're helping those alternative businesses. So hopefully I answered that. Happy to talk with you more offline, whoever that might be. But on the next screen, next slide, how do you actually get the money? Documentation, documentation, documentation. The person with the most documentation wins, right? I mean, I could give you examples beyond belief, but I'm sure you already know this. 1, your business plan. What do you want to do? Oh, you know what? We skipped a slide. I think can we go back real quick? There we go. You need to know this. If you don't know this, your lender is going to say, I'm not going to lend you because you don't even know why you need money and what you're going to use it for. So the business plan. What is your product or service? Maybe who's your niche customer? Who in your target market? How are you going to distribute your product or service? Are you going to deliver it? Is it online? Do you only have you do it through trade shows? What have you? Who are your competitors? If you charge $1,000 an hour, easy numbers, and all your competitors charge $800 an hour, you need to be able to sell yourself that you add value to your customer for that extra $200 an hour or product, whatever it might be. If you can't, then guess what? All those sales are going to go to your competitor. In America, we always want bargains. We want to pay for the value that we get. We're not going to overpay for something just because. What about your marketing plan? How are people going to know about you? who, you know, do they reach you versus social media versus trade events versus having a loyalty program, versus whatever your marketing is. North Metro SBDC has 4 marketing consultants that can help you from SEO to website design, what have you, all free. And of course, the last 2, what this is all about of getting capital is what are your cash flow projections? 20 years ago, a lender wanted to know 1 year, 5 year, 10 year. Well, guess what? The world has changed. They want monthly for 1 year, 2 year, maybe monthly or quarterly, and 3 years. After that, the world changes. Who the heck knows what's going to happen? But you need to have those cash flow projections. Know when you're going to break even. Know where your shortfall is or what have you. And again, legal. What's your legal structure? What's your accounting structure? What are your financial statements, your balance sheet, your income statement? Proof is in the pudding. It's the documentation that the lenders are going to use their best ideas or for their underwriting requirements. Will you be able to pay them back? So Sarah, if you can go back to that last slide a little bit. Your business, your cash flow, we talked about it. What's the experience you have in the industry? Your financial credit, we talked about. I cannot stress enough, team of advisors. I work primarily with business owners. I like to think as a financial planner because I work with accountants and attorneys and municipalities and economic development resources. I like to think I'm the most important person for my client. I'm telling you, it's your CPA, because you either put more money in your pocket or it goes to the government. So SBDC, have your team of advisors. SBDC, free services, your cities that have economic development associations like Arvada, your CPA, your attorney, an insurance agent, HR consultant. We have that at the SBDC, marketing consultant. That's, you get it by having your team of advisors sharing their wisdom with you, you being prepared with your documentation, and then you ask. So that's in a nutshell, very quick, lots of information. I hope you all found this valuable. Happy to have any open discussion, any sort of case study if you want to talk about it and share it with the group so they can learn, or we can do it offline with any of the resources you have from Arvada, from the city, from the SBDC. Sarah, is Raul, any other thoughts?
Yeah, so just to reiterate, first off, thank you, Karen. That was amazing. And for sharing your knowledge, your expertise, your experience. And if anyone is confused, because as she said, it's a lot of information. The recording, yes, we recorded it. I will get that slightly edited and out to AEDA so they can forward this to the list. It's better now. Good. Okay, my sound is better. So yeah, we'll get this information out to you so you can see the recording, have it handy, and any relevant links. So the link to schedule with Karen, free consulting in general with the SBDC, any resources that AEDA has, and other city partners that are here as well. If you want to just shoot me an email saying, hey, can you include us? I think AEDA will be cool with the, shooting your information over as well for those cities that are needing that information. Yeah, we'll make sure we get all that to you guys. That's what we're here for. That's the whole point of this. It's not like, hey, you get the information now or not. No, there's ongoing support. That's the most important piece of this, actually, is that please reach out to us, reach out to the city, your city economic development organizations, so that you can continue to get support in this specific area and all the different needs that you have as a business owner. That's the way to win. Trying to do this on your own, virtually impossible for most. So, any other notes for y'all over there at AEDA?
The last thing I will say is hopefully you will feel a little bit more prepared. And Isa, you can go into this, but the last of the 3 sessions, there will actually be 4 lenders on the hotspot. I will be moderating that program, and you can hear directly from them of what they can tell you and can share with you. But they can tell you a lot more detail of what their financial institution has for their underwriting criteria. This hopefully is a great opener for you. And Isa, I'm sure you want to share about the other 2 programs.
Yeah, no, thank you so much, Karen and Raul, for the presentation and the useful information. Again, yeah, the next 2 programs are going to be in person too, so I highly encourage all of you to come to those. For that panel discussion, we will have opportunity for you to engage with each of those lenders one-on-one and ask more personalized questions, or anything specific that you want to have answered for your business. I would also just stress, lean on the SBDC. They've been an amazing resource for all small businesses. Also lean on your economic development organization. I know there's a lot of different municipalities being represented here on this call, so happy to share our contacts. We work really collaboratively and closely on a regional scale. And then for any of those Arvada businesses, please reach out to us. Again, we have a ton of resources that we're really eager to share with all of our businesses, so please reach out.